In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, good afternoon. Once again to all of our market rebels, welcome back to another edition of Coach's Corner. And we like to just bring you different topics and usually in the theme of options to help you make better decisions and become better options traders. And today, Stu, we've got another cool topic lined up.
Excellent.
A little bit of a surprise, but I know you get a lot of questions on it. We get it in Q&A. But I thought it would be a good topic because so many people, even people who work in the industry, get confused about this topic, and yet it's something that traders should at least have a reasonable grasp on.
For a bunch of reasons.
Yep. So here's the topic, and you're going to guess what it is by looking at our Chalk Talk question. Here we go. You got $10,000 worth of stock on margin. What stock value is required to trigger a margin call?
Let's see here. First thing that comes to mind here, Bill, is, and listen carefully, everyone, because there's going to be a bunch of you out here who say, this does not pertain to me.
Yep.
Because I don't trade on margin.
That's exactly why I put it in here.
Be careful about that, because while you may not trade on margin today, you may find yourself in a situation via a number of different avenues, which you are in a margin situation, not by choice.
Right.
Not by choice.
And how is that possible? Because
know about this topic.
Yeah, you got to have a margin account to trade options, and you might get assigned.
You might.
And the only way you can handle the assignment is to be on margin. And now you're going, what's all this margin stuff?
Yeah.
How did I get a margin call? What is this? I don't understand. So you need to at least have the basics, even if you never plan to trade on margin, because in order to trade options, you do need a margin account.
My head is going 1,000 miles an hour here. Let's see. I'm in this option position. I get assigned. I get stuck with the stock. I kind of want to keep the stock. I can't keep the stock because I don't have enough money in the account. Now I have to dump the stock. The stock starts running away. I kick myself in the you-know-what because I can't keep the stock. Or I hit a margin call because the stock went down, and now the brokerage firm is going to start dumping other stuff that I don't want. It's like it just goes on forever.
It can absolutely perpetuate. Yep. So again, now there's going to be a little bit of math in here. Don't worry about that, because your broker's platform will make very sure you're aware. They will typically give you a phone call as well. But as soon as you log on to your account, you're probably going to get a big splash banner that's going to say you have a margin call or whatever. They're going to make real sure you know it. And here's the amount of it. So you're not going to have to calculate any of these things. We're doing it just to show you that there's a method to the madness where these numbers come from. Brokers aren't just making up numbers and saying, here's how much you owe us. So the topic for today, if you haven't already guessed, some basics of margin trading. This can get really super complex. but we're going to just try to, again, give you the essence and where the numbers are coming from to help you understand better the idea of margin trading. So first off, understand there are different types of accounts. If you open a brokerage account, you have, whether you know it or not, a cash account where all assets must be fully paid. Now you can open up what's called a cash account, and that's all it is. Everything has to be fully paid. But you can also open a margin account where you can borrow 50%, subject to a $2,000 minimum. That means you can't buy $1,000 worth or have only $1,000 equity and try to buy on margin. Got to have at least $2,000 minimum equity. The primary reason for a margin account is for leverage, and you'll see how that works in a moment. But it's also important to understand, even if you have a margin account, inside of the margin account, there sits a cash account.
Bill, I have a question.
Sure.
The $2,000 minimum,
right?
Does that vary among brokers, or is that across the board?
Good question. And I should have said that is absolutely, it's a federal regulation. That's every broker is going to subject you to that.
Got it.
Yeah. Now, brokers can make any rules stricter, but they cannot relax them. So it's possible you could have a broker that says we require $3,000 or $4,000. The problem with that is that then they start losing a lot of competitiveness. So for the most part, they all tend to have the same requirements, but that is the bare minimum. So whenever you're filling out an account application, usually online, you're going to see something like this. Be a little checkbox, and it'll say, you must click on add margin trading if you want to do it. And subject to approval. Now, they're not going to do a credit check. You're not going to get a hard pull on your records there, but they will. It's just really a separate set of paperwork they have to do, very small, just to say that I want margin trading. If you have chosen to have margin trading, it does not mean that you need to use it. So think of it a little bit like a credit card. Just because you have a credit card doesn't mean you need to use it. And if you do use it, it doesn't mean that you have to float a balance and pay interest. It just gives you that ability. So that's an important thing to understand. So let's find out a little bit more about some of the details and some examples of margin trading. But before we do, Stu, reminder for all of our traders out there, marketrebellion.com/get started. Great way to get started with your options trading careers. A lot of great videos, articles, and things to help you build a really firm foundation.
And Bill, isn't it also true that idle cash sitting in an account can, depending on who the broker is, pay an interest rate to you as the client?
Oh, sure. Yep, absolutely.
And that rate will vary.
That rate will vary too, but you could be sure it's going to be a lot less than the margin rates that they charge you. For sure.
For sure. They're in the business of making money, not losing.
They're not going to loan it to you at 3% and let you park it in the money market at 5%. Right. That'd be a great deal. So let's talk about some of the basic benefits of margin. One thing is that you will reduce the chances of what are called account violations. I'm not going to talk about them here, but you have what are called liquidations and free rides. They're related topics, but they are different. They're super easy traps to step into in a cash account. So, and a lot of traders don't know this until they finally get locked out of their account with what's called a CUF, a cash upfront restriction, for 90 days. They can only do closing orders, and they're going, what happened here? Well, that's because you didn't understand the mechanics of a cash account. And so if you have a margin account, you really don't have to worry about those anymore. Another benefit is you can withdraw cash against the account. So let's say you need whatever, $10,000 you're going to put down on a car. If you want to put that on a credit card, you'll never climb out of that debt, right? At 29% interest that some of these guys are charging. But these are secured rates. So a lot of times they're a whole lot less. I'm really surprised in today's markets that some of them, we'll look at some rates in a moment, but they're still typically a lot less than credit card rates because they are secured loans. They're secured by the assets in the account. The primary reason, if you hear a trader who says, oh, I trade on margin, it's because they're looking for leverage.
And Bill, when you say assets in the account, just make sure everybody knows the assets in the account are stock, right? Could be stock.
Well, you could have, just if it's a marginable security, it could be bonds.
Could be the product that you own has a value to it.
Correct.
And that value is used as collateral. right?
Assuming it's marginable, correct?
Assuming it, yeah, and that's right. Not everything is marginable, but assuming it is marginable, that's what Bill's talking about. Correct.
Absolutely. So the margin account, the way that it came about, little history here, it was in 1934, the SEC, Securities and Exchange Commission, provided for the extension of credit by brokerage firms under what was called Regulation T, or Reg T for short. So again, another very clever government name there, Reg T. So if you see this on your account, it might say Fed call or a Reg T call. And that's where it gets its name from. But notice that this was in 34, so it's shortly after the crash. And the main reason that the SEC did this was to provide a more liquid market. So the feeling was that if the markets start to crash again, you might be sitting here going, man, I'd love to buy. This is such a super buying opportunity. I don't want to sell anything to buy because everything's crashing. And I can't get a check to my broker in time, especially back in 1934, or wait for it to clear. What do I do? Well, there's nothing you can do, but if you had a margin account and you could trade on margin, you could buy right now. And so that would hopefully provide a little bit of buying pressure in some more times of market turmoil. So that was kind of the history and the reason for creating it. So again, not all stocks are marginable. And just because it is marginable today doesn't mean that it can't lose that status, and vice versa. May not be marginable today and in the future become. So OTC, over-the-counter stocks, or penny stocks, pink sheets go by different names, and IPOs, initial public offerings, are not going to be marginable, at least right off the bat.
Typically.
IPOs, right. The IPOs you'll go through sometime. They typically will be afterwards, but not right on the IPO. The margin trading, the basic, and I said margin can get complicated, so these are just the basics. You will generally deposit 50% of the trade. Whatever you see, buy $10,000 worth of stock, you get a deposit $5K. Now, again, this is subject to a $2,000 account minimum. So if you've only got $1,000 in the account, you're not going to be able to trade on margin by borrowing money. And again, it's an automatic process from signing the margin agreement. It's no different than swiping a credit card. You don't need to call somebody and say, hey, I'm going to trade on margin, or is it okay? You just enter the order and the broker will figure it out if it is required to be on margin or not.
And everybody can kind of see that somewhere up in the corner in their account somewhere, it'll say,
oh, yeah,
in power, which is typically going to be.
Yep. And we'll talk about that. Yep. Margin cash available, option buying power, all that stuff. So it's an automatic process. Now, the broker is going to assume that you want to use all cash first before going on to margin. All right. So don't think, well, I want to keep the cash in case this happens. Mathematically, it all works out to your advantage if you use your cash first and then go on margin. So the system will figure out if you need to be on margin. So let's look at a couple of examples. Let's say that you buy 100 shares of ABC stock for $100 a share. And in the business, we would call that the market value long. So if you work in a, let's say, a margins department for a brokerage firm, they will call it the MVL. And so your market value long is 10,000. Your Fed call is going to be how much, Stu?
10,000.
Your Fed call is 50%.
Oh, 50. Yeah, that's right. I'm always thinking cash. So but the margin is 50, so it'd be half of 10 or 5,000.
$5,000, right. And what you're going to do is that means you've got to cough up $5,000. Now, if you've already got it sitting in the account, there's nothing you need to do. It'll just automatically sweep out and fill. Right. But they're still going.
It's not like you got to deposit $5,000.
Right. No, it just means you need to have it in the account. Right.
You've already done that. You've deposited money into the account. Now you have an account that has money in it, and now they're going to draw on it as you.
Correct. On settlement.
Create the requirements. Yes.
Yep. So then what will happen is you will automatically borrow the balance of $5,000. And yes, you will pay margin interest. Now, by paying 50%, or let's say owning half of the shares, you can think of it that way, you're getting 2-to-1 leverage.
You are.
And that's because you're receiving 100% of the stock gains for only 50% down. Okay, so that's the way that works. Here's the slide.
I have a dumb question.
Sure.
Are you receiving, can you go back one? Are you receiving 100% of the stock losses?
Yes, you are.
Keep that in mind.
We're going to look at that. It's always a double-edged sword.
Here. Yeah, the leverage is nice, but listen, like everything, right? There's always the other side. You're going to
You're
get
just changing your
100%.
deltas to a delta of 2 instead of 1, or 200 instead of 100, right? Now, here's some of the rates, and you can see that most brokers put them in little buckets like this. They'll give you a little better rate for higher margin balances. Can't imagine why. But we went through and listed some of them. Robinhood, surprisingly, was the cheapest, 6.75, and down to 6.25 for, actually, it starts at about 100 grand and up. But there's a number. Interactive Brokers is pretty cheap.
Yep, and you actually see their ads. And that's what I was saying before. Like you'll receive interest on their idle cash, and it's kind of the same idea here. They're going to charge you lower rates as well than some of the other people like you see here.
Yep. Now the highest Wells Trade. Look at this, 14.25. This might as well be credit card rates.
I mean, I can
Crazy.
borrow money at 14%.
And you
Sign
think
me up,
the
Bill.
markets are returning on average 10%,
Yeah.
and you're going to pay commissions or at least for options, pay commissions, and with stock paying 14% interest and think you're going to beat it?
Can I get in line for that? I want to do
Yeah,
that.
exactly. Right. I'll be right behind you on that deal. Exactly. But anyway, we can see I went through and did the average here in Excel. It comes up to just about 11%. So that can give you some kind of a benchmark to see if your margin rates are above average or below. All right, so let's look at some
Look at these numbers, people. Just take a moment, take a deep breath, and take a look at them. And these are big brokerage houses. Tasty Trade.
Oh yeah, look at the Citi.
Schwab.
Charles
Like
Schwab.
the old Thinkorswim.
I'm surprised. Look at Schwab at 13.
Unbelievable.
I
Man.
know.
Unbelievable. E-Trade.
Yep.
Yep.
So let's take a look at some examples here. So let's look at what equity is. That's the term that they use in the brokerage business. You've probably heard it with your house too. It works exactly the same. So in my example, we had market value long of 10,000, but you borrowed 5,000.
Mm-hmm.
And in the business, we call that the debit balance.
Mm-hmm.
So we're going to subtract off the debit, and market value long minus the debit equals your equity. So you can think of equity as what you own minus what you owe. So you're owning or controlling $10,000 worth of stock. Now you might make the argument, well, I don't own it because I didn't fully pay for it. Well, that's true, but that's just to kind of help people understand what equity is. You are receiving, you're in control of all of those gains and all of those losses. So it's as if you owned it.
Yeah, you have the stock.
You own the stock. That's right. And that you just happen to owe this debit balance.
That's right. You buy 5,000 shares. You have 5,000 shares. No matter how you're paying for it, you have 5,000 shares.
Correct. Yep. So here's the first thing to understand about why it creates 2-for-1 leverage. So if we have our market value long at 10K, let's say that it rises to 11,000, right? And you'll look in your brokerage account, it'll say total value is 11,000. Assuming you're not paying periodic interest and paying down this debit, we're going to assume it's going to stay reasonably constant in the short run, would still show 5,000. But notice we've gone from 11,000 minus 5,000 to 6,000 equity.
Yeah.
So look what happened. We went from 10,000 to 11,000 increase in market value. That's a 10% increase. But
And
your equity,
just to be clear, what happened was the stock went up, right? I mean,
yeah, stock went up.
That's it. That's all that happened here.
Now, this could also be, not to complicate it, you could have 10 stocks on margin, and it would just all get wrapped up into this bucket of market value long. So, but to make it simple, I'm just going to use one stock. But that could really be 5 stocks. It might be 100,000 market value long.
Could put you just one.
As a point, it's exactly what it is, right? It's your portfolio of market value long. So you can see that if that increases 10%, your equity increases 20%. So if you shut everything down, sold it all, paid off the debit, you would be up 20% on your money, 2 times the change in the stock's price. But as we said, it's a double-edged sword. Let's say it went down to 9,000 instead. That's a drop of 10%. What happens to your equity? Bang. Big hit.
Hate when that happens.
Hate it when that happens. You're down 20%. So again, this is the basic reason for using margin for traders. They're just trying to get some leverage. Now, the real gunslingers might buy the 2x funds or the 3x funds and try to use margin or margin cash to pay for these and try to really bolster that leverage. But that's the basic idea for using margin. Okay, so with that little background, let's move on. Before we do, please remember marketrebellion.com/get started. I can't emphasize so many good videos, articles on there to give you a good foundation with options. So let's talk about a margin call. Dreaded. There's actually a movie called Margin Call. Wasn't very good, but yep, number of years ago. So it is a well-known thing, and anybody who's ever traded on margin knows all too well, probably, about margin calls.
Yeah, this is not when you get a margin call, everyone. It's not good.
It's definitely not good.
Things are not going the way that you had anticipated they will be going, and you're getting a call from the powers that be that are running the money saying,
Yep.
"Yo, dude, you owe us money.
Over here.
Cough it up."
So we said earlier that your equity must begin at 50%, but it's allowed to drop, right? You can't say, I started at 50, it's gone to 49.5 and you owe money. They give you a little bit of wiggle room, but only so much. If it falls too far, you'll get a margin call, also called a maintenance call. Now, we're going to find out where those levels are, but the NYSE, New York Stock Exchange minimum is 25%. But as always, brokers are allowed to make rules stricter. Most brokers, I don't know of any who are over this or even under this, most of them are going to be at 30%. So they give themselves a little cushion. I'm sure they'd love to be at higher percentages, but again, then they lose their competitiveness.
Right.
They'll say, hey, I'll just go over to this broker. He's only going to require 30%. So again, it's kind of a balancing act. And you're going to find that what's called the house percent is probably going to be 30% at your broker. Now, you might have a concentrated position. You've got a big portfolio, but 70% in NVIDIA or one stock. They might say, okay, that's a concentrated position. We're going to require 50% or 70%. Remember, brokers can make any rule stricter.
Bill, can they change that number on the fly?
They can. We're going to talk about that in a little bit. They absolutely, and that can be another reason to be very careful about margin. Okay. Absolutely. So hold that thought. We've got a slide on that. So let's talk a little bit about this equity percent. That's something else you'll see on your platform. It'll say, what percent are you? If you're not on margin, it's going to say 100%. But in my example right here, our equity is 5,000. We're going to take the equity divided by the market value long, and that's 50%. We're in, let's say, in balance. According to Reg T, we need to have 50% equity, at least at the start. Okay, so that's how you're going to start out. But now let's answer a really interesting question. At what level will you get a margin call? How far can it fall? Now, this is something your broker will probably not show on your platform. If you call the broker, they can probably calculate it for you and tell you. But it's a good idea to have a pretty good estimate of where that line is.
If you find the right person, that is.
Well, that's wouldn't be the first time that people get bad information, which again is why it pays to understand it.
Yes, absolutely.
So if the broker requires 30%, you have to take what's called the complement. I said there'd be a little bit of math. The complement in math is if it's a number that we would add to, let's say, to 30% to bring it up to 100%.
Yeah, so 70.
So if we take, I'm going to use 30% as 0.3. If we take 1 minus 0.3, gives us 0.7 or 70%. That's the complement because 70 and 30 equals 100. So what you're going to do is you're going to take that debit balance divided by that complement. So in this example, it would be 5,000 divided by 0.7 or 7142. So let's see if that works out, Stu, if we did our math right. Here was our initial level. Let's say the market value drops to 7142, debits at 5,000. Equity has dropped to 2142. And what do you suppose 2142 divided by 7142 is? 30%.
It's going to be 30%.
Yep. See, now you're starting to understand the method to the madness. That's why the broker is going to come. That's where these numbers are coming from. Now, again, your broker is going to show them, but you're going to be scratching your head going, where did they come up with 7142 or where did they come up with this maintenance call number? It's all about this 50% requirement or the house requirement. So let's look at a margin call. Let's say instead of dropping right to 7142, you can think of this as our line in the sand. If we drop 1 penny below this, we are technically in a margin call. So let's say we get up one day and it's dropped, gaps down to 6,500. What's going to happen? Well, again, we're at 23% equity. We have to be what? 30%. We
So,
know we
Bill, time out just for 1 second. So can you go back one slide? Okay, so what Bill's saying here, I'm pretty sure what Bill's saying here is that if your MVL dropped to 7142, you're still okay, right?
you're right on the edge of okay.
They're not going to bother you. They're just going to
Not going to bother you.
business as usual. But if you start to drop
1 penny.
just think of your stock value, just think of your stock going down, right? The value of it is going down and it hits a level and you're still okay. You have a little bit of a cushion, but if it goes below that level,
30%.
where Bill's going now to 6,500, go ahead.
Yeah, so now we're going to assume that we are definitely in a margin call. So here we're not, but we're right on the edge.
Right on
And
the
this
edge.
is a good kind of ballpark to know where that line is.
Yeah. And all Bill did was he took the 5,000 divided by the 0.7, right, to get the 7142.
And if your broker had a 40% house requirement, you divide it by 0.6. That would be the complement of 0.4. Right.
And that would be, that's right.
Yep. So let's come back here. We wake up, we see our account is at 6,500. We subtract off the 5,000 debit. Our equity is 1,500. Your platform shows that you're at 23% equity. You know your broker has a 30% house requirement. We know we've got a margin call. All right, so here it is again, 23%. How do we figure this out? Now, again, your broker's going to do it, but I'm just trying to show you the logic of it. Work it backwards. What are you required to have?
30.
You're required to have 30% of 6,500 or 1950. Right, so if I had 1950 divided by 6,500, it would give me 30%. But how much do we have? 1,500. So how short are we? $450. That would be the margin call.
And so your broker would call you up and say, hey, Stu, send us $450 ASAP.
Yep. I've got a slide for that, but we might as well talk about it. It's technically due immediately by close of business. In this case, it's probably not a huge margin call. They will probably try to work with you and say, maybe the stock gapped way down. Let's just see if you can appreciate out of it by tomorrow. If it's a massive margin call, and we'll talk about that, they're probably just going to start shutting it down. But something like this, they might just kind of not worry about it.
When Bill says appreciate out of it, what he's referring to is the stock going back up.
Stock going back up, and now you're out of maintenance.
Right. Now you're out of maintenance.
Yep. So let's look at some of the ways that you could meet a margin call. If you meet it with cash, right? Here's our setup right here. So the broker says you got to cough up $450. You drop off $450, wired in, whatever. What happens now? Well, your market value doesn't change. You didn't buy more shares. What you did is you paid down the debit. So your debit goes from 5,000 to 4,550. That's just 5K minus 450. And there's your equity at 1950. And we are right back to 30%. Now, important point here. Can we be in maintenance again tomorrow, Stu?
Absolutely.
Yes. So the moral of that story is that if you get this dreaded maintenance call and you can afford to cough up more money, it's probably a good idea to give yourself a little extra cushion than putting yourself right on that line.
Yeah, look, I'm kind of making light of it a little bit, and I really shouldn't. This is not funny. But what's happening is the market value, the stock went down. Let's face it, the stock went down. Went from 10,000 to 7,000 to 6,500, and now I have a maintenance call. So I meet the maintenance call. What's to say that tomorrow it's not going to be 5,000
or later that day,
or later that day even, and then you get a second call.
Yep.
So, this is one of the issues with, the whole picture of margin and trading on margin. And, it's just...
Which is why part of the underlying theme here is another big benefit of options, especially stock replacement. We can make a portfolio behave almost like stock and have none of these problems and no margin interest.
You're not going to have to even deal with any of this stuff.
Yep.
You just won't.
So what else could we do? We could also sell shares. That's another way we can meet a margin call. Maybe we don't have the cash or don't want to put more cash in, but we want to sell some shares. And it does not have to be the shares necessarily of the stock that maybe is causing the margin, but we have to cough up cash via selling shares as opposed to cash. Now, a lot of people with...
Who gets to pick what shares get sold?
If the broker gives you a call and says, "Hey, Stu, you've got a margin call," and you go, "I'd like to settle it by selling shares," they'll say, "Okay, what would you like to sell?" They will give you that choice. If they say, "Oh my gosh, Stu's account just imploded, start selling stuff now," they're going to make the decision for you.
Or maybe you can't get a hold of you. Maybe you
can't get a hold of you. Exactly. Right.
They're not going to wait around. That's my point. They're not going to wait around for you to kind of show up. Right. If they need to raise cash, they're going to raise cash. And there's all kinds of implications to that as well. Right. They may sell shares and something you don't want to sell shares in. They may create tax implications. They may. That discussion can go in 27 different directions.
Yep.
So yet another issue that you need to deal with.
Absolutely. Now, let's see how you would meet this with shares. A lot of people think I would have to sell $450 of shares. Not true. So let's go back to our basic setup. Equity is at 23%. How are we going to figure this out? 30% is the house requirement. 6,500 times 30%, like we figured out before, we need $1,950. 450 is the margin call. The way that we figure out the shares is we need $450 margin call divided by the house percent is $1,500 worth of stock.
Yeah.
And here's the way the math works out. Market value long goes to 5,000, right? It was 6,500. We knock off 1,500. Market value long is 5,000. But notice that our debit has been reduced too, because we generated cash.
Because you sold stock and you have cash.
Generated $1,500 to knock down this debit. So now our margin account looks like 5,000 minus 35 equals 15. And we can see that we're right back up to 30% equity. Okay. Now, what are some of the risks of margin calls? Well, as we mentioned before, they are technically due immediately, and that means close of business today. Again, if it's a few bucks, $100, I mean, it's all relative, but if it's you got a fairly big account, it's a couple $100, they might not even really say anything. They'll certainly watch, but they might just say, let's see how it plays out by Friday, but keep in touch with us, that kind of stuff. But technically, they are due immediately. You can meet them with cash, sales of stock, or securities deposits. So maybe you've got a safe deposit box with shares of stock. You could deposit shares to the broker. All right. And that would also be a way to meet a maintenance call.
At the current market value.
Exactly. Now, the broker is not required to give you notice for a sellout. This is a little bit about what you were talking about, Stu, and this kind of catches people by surprise. If it's a big down day and you see that the broker might say, "Hey, you've got a concentrated position, it's completely imploded, we're just going to start shutting stuff down. We're not even going to give you the courtesy to even try to call you. We're just going to start selling out." So one of the morals of this story is if you think that this might happen, or maybe you've been inching closer to that maintenance call, you can call the broker and say, "Hey, if I end up in a maintenance call, could you please sell security A or A, B, and C first before anything else?" I would definitely make sure that they know if you have a preference. Otherwise, they're going to do the choosing for you.
Let me note also, I've had clients call me with this story, the same story that Bill is describing. And the broker agreed to give them that heads up.
Yep.
And what happened?
No, all deals are off.
They didn't get it. Oh, sorry.
Didn't get it.
We had to cover it. My boss.
Yeah, we had to cover it.
Again, you kind of know what kind of pool you're swimming in here.
Absolutely. Now, the reason for this is that according to FINRA rules, that investors borrow individually, but brokers loan collectively. And so what they want is to protect the brokerage firm, not the traders. And here's where it can be another big trap. They can choose the assets other than the one creating the margin call. So now think about this. Let's say that you've got,
isn't it?
Oh, yeah. Let's say you've got, I'm just going to use letters so we don't think that people are trying to give hints or anything. We've got A, B, C, D, and E stocks. And B, C, and D are going through the roof. Everything's going fine. But A is tanking. And that's really the one that's driving the account into maintenance. If it were up to you, you'd probably shut down A.
You might.
And they might go, nope, we have far more loans out in B, C, D, and E. So to us, they pose a bigger risk. We're going to sell you out of those. So they end up making you hold the thing that's creating the margin call, and they sell out all your good stuff. I mean, you talk about a double whammy.
Doesn't really seem fair.
It doesn't seem fair, but this is why right here, that rule. So the big danger is that you're most likely selling at the bottom. Now, a much bigger trap is that the broker can change requirements. I think you mentioned this before. So let's say that you have,
and that's the 30% that you're talking about, right?
Exactly.
40, 50,
call them
60,
the house
70,
requirements.
80. Yep.
So let's say that you have, I don't know, maybe something like a GameStop. Remember when it was at 600 volatility, went from kind of whatever up to 600, and they're going, man, this thing is just bonkers. Even though it's moving in your favor, they might say, you know what? We're going to make it an 80% margin requirement because it's just all over the map. So you log onto your account yesterday and you say, oh, I'm at 75% equity. I'm golden, no problems whatsoever. And yet that same day you get a phone call and they say, you got to cough up a check for $100,000 today. And you go, why? Well, we just changed our house requirements. You don't have enough equity. Another strong case for doing stock replacement. I've had to make those calls, Stu. They're not fun. And brokers can change that on a whim.
Just doing a little calculation here. So 7142 is that first example. If I use that 5,000 complement, so if I went to 80, it would be
0.2.
0.2. Oops, 5,000 divided by 2, which really needed a
well, it would be 5 times that. It's 1/5, so it'd be 25,000.
It's just crazy stuff, man.
Yeah. You got to cough that up. Now, all of these numbers are coming from what's called excess equity. And if you understand this, you'll understand your option buying power, cash available, check writing ability, all that kind of stuff. So let's say this is our basic setup that we saw before, and the market value goes to 12,000. Subtract off the 5,000 debit, you've got 7,000 equity. But what's required? How much equity are you required to have at 50%?
35.
6,000, right? Half of 12,000.
I keep doing that. Yeah. 60.
You're required to have 50%.
Yeah.
So, but you've got 7,000.
Mm-hmm.
You're required to have 6,000, but you've got 7,000. So your broker is going to show you on the platform $1,000 margin cash available.
What can I do with that, though?
Yep. You can use this to request a check. You could buy options with it. See, this is where people get confused. They'll say, well, options are not marginable. How can I be on margin for when I'm buying options? This is how. It's because you're looking at your option buying power, and it's coming from the borrowing ability from your stocks. So that's another little trap that people get into. This is called margin cash available. So sometimes your broker will show check writing ability, and then they'll show you check writing plus margin cash.
And here's a trap.
We're trying to separate that out.
You have margin cash available. You call them up. Hey, Bill, send me a check. Bang, your check comes. And now you're
on margin.
Now something goes wrong, and now all of a sudden you got to call.
Yep. Yeah. So that's a good point. If you call up your broker and say, how much can I write a check for on this account? You might be thinking, how much cash do I have in the account? And your broker might say, oh, it's $15,000. You go, oh, great, send it to me. And now you're on margin for $12,000 because you only had $3,000 in cash. So be very careful. You're saying, is it actual cash or hard cash or margin cash? So if you see those terms, that's why they separate those out. So let's say that you withdraw $1,000 cash. What happens? All right, we said that the market value is 12,000, but your debit goes from 5,000 to 6,000. Equity is now 6,000, and look at that, we're right back to 50% equity. All right, so the thing I'm just trying to
you got to keep pace with the market value.
Yes, you do, and that's why it becomes tricky. All this fluctuates; it's different every day.
Yeah, and if that market value starts going the other way, now you got a problem.
Yep. So let's take a look at the initial setup. Let's say you buy $10,000 worth of stock, but you have no debit. You're fully paid for. Equity is $10,000. Your broker is going to show you $5,000 margin cash available because you're only required to have 5K.
Mhm.
All right. So if you withdraw margin cash, what happens? Now we're right back to where we were before at 50%. Your broker might show something called buying power. And buying power is the dollar amount of marginable stocks you could buy. It is not the amount for checks. And generally, it will be 2 times the cash available. So let's say you open an account, you deposit $10,000, you have no debit, you're fully paid. Your account's going to show $10,000 in buying power, marginable stocks, or $5,000 in margin cash available. It might also show $5,000 for option buying power. That's all it is. It's just your margin cash. So let's say that you buy $10,000 worth of stock. What happens? You now own $20,000 worth of stock, but you owe $10,000. Equity is 10, and look at that, you're right back at 50% equity.
I feel like there's like some marketing scamish stuff going on here. It's like, oh my God, I got all this buying power. Let me use it. Bang.
Oh,
It's borrowing money. And all of a sudden you're getting an interest bill at 10, 12, 14%.
This is why this is part of what you signed the agreement for. So again, we just wanted to really step you through. Don't worry too much about the math or the mechanics. We just want to show you that there is a method to the madness. There are very real reasons why these brokers come up with these numbers and say, here's what you owe. It all comes down to this Reg T amount where you have to start out at 50% and down to the house percent.
And there's also another business
trying to keep it in balance
behind the scenes. It's called stock loan, which is directly related to this.
Oh, sure.
I'm not going to go into it here, but it's the banking side of the industry. This is the banking side of the industry, and it's not favored towards the individual. Let's just kind of leave it at that.
Yep. So anyway, we hope that gives you some things to think about and a little more appreciation for some of the numbers you see in your account. They'll hopefully make more sense. But probably the bigger message here, when Stu and I talk about things like stock replacement, especially for longer term trades, and you're going, okay, yeah, but it's just a deep in the money option. Yes, but there's so many benefits. You're getting probably 4-to-1 or 5-to-1 leverage. Here at best, you're going to get 2-to-1. Even if you can go 4-to-1, it's just intraday. You can go 4-to-1 for years, and you'll never have a margin call. You'll never pay margin interest.
And here's another thing, Bill. While you're saying, my head's like spinning here. So yeah, if you buy that stock replacement, you're going to pay that little bit of premium and extrinsic value, and part of that is interest rate driven.
Correct.
However, that interest rate that you're paying is going to be far less.
Oh yeah.
Than the margin interest that you
even if you're on the who was it, Robinhood, even if you're at, it's not going to be 6% in the markets. No.
Yeah.
Yep.
So
we can also create things that are called synthetic dividends, where even if the stock doesn't pay a dividend, you're generating interest on the cash not spent for buying the stock.
Mm-hmm.
So once you understand all the moving parts, you can really develop some very interesting strategies. But we just wanted to kind of run this by because, for all of our viewers out there, because we find so many people have questions about margin and what do these numbers mean and where are they coming from?
And what's really cool, Bill? I'm just going to kind of reiterate what you just said. All of this that we went through, if I chose to, I don't have to deal with any of this.
No.
Simply
Zero.
By owning a 85 or 90 Delta or 95 Delta call.
Right. And all of this is erased.
It's
gone.
Paid for. It's gone. It's done. You're not going to get the call. You're not going to get a maintenance.
Probably got 3-to-1, 4-to-1 leverage, no margin interest. You're like no margin calls. You can roll it. There's a lot of benefits from doing it.
You can't roll stock. I mean, eventually you're going to wind up with zero, right? I mean, it goes up, you sell some. It goes up, you sell some. It goes up, you sell some. Pretty soon you're done. You're
out of deltas, out of shares. Yep.
And you miss the next 200 points.
Yeah. Now I did mention that margin can be very tricky. I'll just leave this as a little cliffhanger for people. There's another thing called SMA, a special memorandum account. You will not see that on your platform, and chances are, if you call the broker, they're going to say, what are you talking about? It's a behind the scenes in what's called the cage. That's where they handle all the money in the brokerage firms. But that's where they track excess equity. And that's a whole nother fascinating side to margin. Maybe we'll even do that as a coach's corner sometime. But let me at least leave you with something to think about. If you are going to transfer your account from your current broker to somebody else, especially if you've had it there for years, tell them you want to transfer the SMA2. It is a request. They will not do it automatically. And that can really be a massive benefit if you've had, it's called a high watermark. If you've had a lot of appreciation in the account, even if you're not trading on margin, it can make future purchases much cheaper.
And Bill,
make sure you transfer the SMA.
If you do not ask for that, what
they're going to just, it's gone.
It's gone.
Gone.
Yeah.
But I had a trader when I was on an active broker options team, and he had $1.2 million in SMA. He had the account for years.
Uh-huh.
So this is all the excess equity where he never took checks, but it's tracked in the account.
Yeah.
He journaled it out to another broker,
Lost
gone.
it.
Because he's going, how come you're making me deposit all of this money and my previous broker didn't? They're going, I don't know. He called us back and said, oh, well, it's because he had a whole ton of SMA in the account.
Yeah.
You never. So that's, again, many moving parts. And those are the things we like to show you here at Market Rebellion. So for anybody who is serious about options trading and investing, please check us out, marketrebellion.com/get started. Give us a call. You can get coaching lessons with Stu or Scotty, and we'd love to have you in Q&A.
Yeah.
So with that, Stu, any closing comments?
Yeah, keep your life simple. Look, and I'm at the stage in my career where I'm looking to make my life less complicated. And, going on margin makes it more complicated. So I'm not going to go on margin. I'm going to use an option that replicates stock movement if I want to own stock, and I don't have to worry about any of this. Yep. And that's it.
So final question, you should have picked it up earlier, but what would trigger a margin call? Take your debit, 5,000 divided by the complement, 0.7 would be 7142. That should be a number you always have in the back of your mind. So we hope that helps. We'll look for you next Thursday, 4 p.m. on Coach's Corner. We'll see you then.